welcome. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about markets and what should a long-term investor needs to understand with the current market rally and the way things are actually panning out. With me is Rajeev Thakkar, Chief Investment Officer and Director, PPFAS Mutual Fund. Rajeev, welcome to The Money Show. And we are going to talk about an investor's point of view and the kind of portfolio they might have aligned as per their financial goals. The kind of things that an investor needs to understand for a long-term portfolio are the current market triggers, which are sort of panning out in terms of domestic triggers as well as international triggers. I want to understand your understanding on the interest rate scenario as of now. Looking at the kind of monsoon concerns we have, looking at the kind of data that's coming out, not only from a domestic point of view, but also internationally. Just on the interest rate front, what do you think? Is this interest rate hike pause will be an ideal situation, or you see one rate hike coming up?
So I don't have very strong views whether we are at the peak of the cycle or we could see maybe one or two rate hikes in the coming days. But what is clear in the current environment is that we are clearly not in the very, very low interest rate regime that we saw globally as well as in India. Rates have moved up in terms of nominal rates, as well as now you will start seeing real positive returns to investors. So people who were moving away from fixed income securities in chase of real yields, or in terms of not getting negative real yields on their investments, they don't have to do that anymore. And fixed income is becoming an attractive asset class for people who have short to medium term needs. That's the way we are looking at it.
For the fixed income investors, a lot of them might have actually revamped or reshuffled their exposure when it comes to equity and debt. Do you think there is still a scenario where they can consider medium to long-term duration investment, or you think they should strictly stick to short-term parking of funds in any fixed income right now?
Yeah, so I don't think we are going down in a hurry in a very big way, given that inflation concerns have not gone away and inflation rate remains somewhat elevated. So people who are looking to buy very, very long-term bonds in the expectation that rates could come down and they could make some short-term returns in terms of bond prices appreciating, I don't think that's a great thing to do. People who have longer term debt needs as part of their core asset allocation, they could consider investing some of their funds in such instruments. But otherwise, I would recommend sticking to the short to medium term debt instruments. And if someone has extra long term money, I think equity would be a better place to park.
Your analysis on the corporate earnings that we saw in the first quarter and now the rest of the quarter, what is your sense? What are the kind of triggers you think, if at all an investor wants to have a sectoral exposure and is looking for a time horizon for say maybe 3 to 5 years, you think going ahead that can make sense to them?
So results were more or less good across the board, with the exception, with certain sectors being exceptions. So easing of input prices, commodity prices was good for a broad set of companies, but people in this space saw somewhat muted earnings. And you saw some sectors contributing positively in a big way, especially the banking and financial services companies and oil companies to some extent. So broadly, results were more or less in line with expectations, and results were looking good. In terms of different sectors and where we see them at this point in time, I think consumption-oriented names, both discretionary and non-discretionary, as well as retail-focused names, are looking very, very expensive at this point in time in general. And I think there are select PSUs, or there are banking names which are looking reasonably attractively valued at this point in time.
All right, sectors one can be bullish and also in fact have them as a part of their portfolio, align them with the financial goals. But then Rajiv, one very specific question that the investors are also worried about, mid-cap and small-cap space. Talking about investing through mutual funds, they are seeing good and fat returns on their portfolio right now. One needs to be diversified across market caps, okay? But do you think it's time to just wind up your slight exposure in mid-cap, small-cap, and maybe you want to relocate that to large-cap, because now the story is changing, looking at the broad-based rally, and we will see active large-cap funds participating?
So what one sees across cycles is that when markets are rising, mid caps do better than large caps, and small caps in turn do better than mid caps. And in falling markets, it reverses out. So mid caps fall faster and small caps even faster. Recently, what we have seen is small cap returns have been very, very high, small and mid cap returns, and which has resulted in a lot of retail investors chasing funds investing in this space. From asset management companies, we have seen a lot of them actually taking steps to shut their doors for fresh inflows and restricting inflows. So, which is a clear indication that somewhere things are getting a bit out of hand. Broadly, as you mentioned, we should diversify across market cap. But if someone is extra invested in the small and mid cap space, it may be a good time to consider shifting to the large cap space.
One word of caution, if you have to give to the investors investing in small cap, what would that be?
Don't chase returns, very, very simply, because many a times the returns may be illusory. You may, based on NAV, think that you have earned very, very decent returns, but that NAV could fall equally sharply the way the rise has been.
One important question, how worried or concerned are you about the elections and its impact on the market?
Not too worried. So broadly, across parties and across governments, there is basic consensus on how the economy has to be run. And in the past, people in the equity markets have not got the election results right, both in India and globally. And even if they knew the election results, they don't know what the market reaction after that will be. So 2 months before the election, 3 months before the election, and maybe 1 month after that, there is this turmoil. But if one can live through these 4 months, I don't think election will have that big an impact on the market.
All right, one last question to you, and then we will wrap up this discussion. I want you to help our investors understand the kind of diversification strategy that they should be following. A lot of experts, especially on social media, keep bombarding with a lot of strategies. Obviously, it's very case specific. It depends on your financial goals and the kind of risk appetite you have, the kind of risk profiling you've done. But when you talk about diversification, there are specific certain categories which already provide you with that kind of diversification. Call it multi-cap, flexi-cap. We even have multi-asset allocation funds these days. We have a good amount of funds in hybrid that, a risk-averse or maybe an aggressive risk investor can invest into. They cannot be a one-size-fit-all kind of a strategy, but basic and important principles of diversification in this current scenario, what would that be?
So firstly, people need to have an appropriate mix of asset classes in their portfolio. You rightly mentioned it depends on the individual's life stage, goals, risk appetite, and things like that. But broadly, one should have liquid funds, which could be in liquid mutual funds, or it could be in terms of short-term fixed deposits or things like that. One will have medium-term debt investments. There would be real estate and to some extent gold, depending on people's need for those asset classes. Real estate for primary residence or business purposes, or gold in the form of jewelry, etc. And obviously, equity is there as the growth asset class and for wealth creation. So across these asset classes, there should be diversification. Coming to debt and equity, you cannot put all your debt investments in one corporate FD and think that that is fine. It has to be either in very, very low risk investments like government and AAA bonds, And even there, some diversification is required in terms of number of issuers, in terms of AAA bond issuers. In equities, if you are going through the mutual fund route, one or two or three mutual fund schemes should suffice because the mutual funds themselves are diversified vehicles. But if you are holding if you are holding direct equity, then you may need a minimum of 15 to 20 companies to spread your investments.
Lovely. Thank you so much, Rajeev, for taking time out and helping our viewers with their portfolio allocation and strategies today. Thank you so much.